The broadcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon. This is Benjamin Levine, Chief Investment Officer for 3D Asset Management. Welcome to our first quarter 2017 market commentary, where we'll be discussing the events that shaped markets' performance during the quarter and provide a near-term outlook in terms of the events that will likely shape market behavior going forward. Just a couple of administrative notes. First, if you have any questions, there's a dialog box on the right-hand side in your panel, and just go ahead and type in your question and we'll answer them at the end. And then the second item is that we'll be conducting a separate portfolio review for contracted advisors shortly after our market commentary webinar. This is scheduled for 3:15 Eastern Standard Time. If you haven't registered for that yet, please feel free to contact the sales rep and we can get a link out to you shortly. So we're at what I would call a reflationary crossroads. Despite posting a strong quarter, global markets actually ended on a whimper as investors' high expectations for fiscal stimulus and regulatory relief hit the hard reality of Washington, D.C. political machinations. In March, U.S. equities weakened when the Republican Congress could not pass its own version of the American Affordable Care Act, calling into question the ability to pass meaningful tax reform and infrastructure spending promised by the Trump administration. Perhaps equity markets front-loaded too many expectations of fiscal stimulus as reality sets in that much of what had been promised won't meaningfully impact the economy until 2018, assuming these policies still pass. Yet animal spirits remain alive and well within the business community as the global economy continues to ride the crest of the cyclical reflationary wave that started last summer. Even though expectations for first quarter GDP growth are now less than 1% for the U.S., the backdrop for U.S. domestic growth appears to be quite robust, with tight labor markets helping to boost capital expenditure spending plans. And though long-term bond yields have dropped, which some have interpreted as a warning sign that the bond market is doubting the cyclical upturn, credit markets and the yield curve still remain supportive of equities. The firming up of oil prices to the $50 to $55 range also signals that the world is not backsliding. This should be positive for pro-cyclical assets, particularly emerging markets. Federal Reserve is also voicing more confidence in their push to normalize monetary policy as public comments by Fed officials point towards 3 rate hikes in 2017, as well as a possible reduction in the balance sheet from their post-2008 crisis levels. If the Fed were concerned about the macro backdrop backsliding into deflation, they would be expressing much more caution, framing near-term policy as data-driven. Last quarter, we asked, will the rush into cyclical assets and away from defensive interest rate sensitive assets cause the pendulum to swing too wide the other way? And the answer is that the pendulum did swing the other way, leaving the small cap value style for the certainty of large cap growth. Finally, we would not be surprised to see the markets go through a bout of volatility despite the positive earnings backdrop. Global valuations look extended amidst lackluster demand for insurance as reflected in options pricing. So bottom line is that we're seeing a swing in styles from small cap cyclical value in the fourth quarter to large cap growth in the first quarter. And we're also seeing a shift in expectations on the part of markets. The markets were expecting cyclical reflation and now they backpedaled on that a little. So in essence, we have what looks like appears to be on the surface expensive global valuations, but global risk also looks cheap. And we could be in for a bit more volatility looking ahead as the market becomes fixated on the Washington, D.C. landscape. This is a theme that we first mentioned in our last market commentary, the year-end market commentary, but I think it's worth repeating because this really is the big picture. It's this notion of renormalizing the new normal, where we talk about the tectonic forces of cyclical reflation meeting head-on with secular disinflation. It's a theme definitely worth repeating. Just to reiterate, what is the new normal? This is a term coined by Bill Gross and Mohamed El-Arian, formerly of PIMCO, back in 2009-2010. The new normal characterizes the post-2008 macro environment as one suffering from the secular deflationary forces of aging demographics, high debt levels, and excess global capacity. Any hints of a cyclical recovery had been met with a crisis, whether it was out of Europe, whether it was from a devaluation from China, a government shutdown in the U.S., or oil price collapse like what we saw in 2014, or ongoing disappointing economic releases such as weak payroll growth. The Fed has sought to normalize monetary policy by unwinding quantitative easing and embarking on a path of rate hikes. Yet unwinding quantitative easing has not been easy. Think of the 2013 taper tantrum, for instance. And the Fed has had to repeatedly backtrack its own forecast for raising rates when the data didn't support raising them. Questions concerning the depth and length of this cyclical recovery have turned into a heated debate over the force and impact of the proposed policies coming from the Trump administration. The debate also hinges on whether the post-Brexit cyclical recovery has enough momentum to overcome the seemingly greater tectonic forces of secular disinflation that have characterized the post-2008 recovery. So here are some key questions to consider as we enter a brave new world of renormalizing the new normal. 1. Can the incoming U.S. administration reverse the new normal overhang on U.S. business production, and will such a reversal manifest itself? That remains to be seen. Certainly there have been some initiatives, particularly regulatory-driven initiatives at the agency level that have tried to free up some regulation, but major policy initiatives have either been stymied or have been pushed out till further in the year. Will a new round of inflation be unleashed as the new administration seeks to roll back government policies regulating large swaths of the industrial sector, freeing up pent-up growth, but also unleashing demand that could push up prices? And will the Fed's goal to normalize monetary policy and preempt cyclical inflationary pressures by pursuing a more aggressive rate hike policy help subdue any macro credit bubbles that could form during a cyclical recovery? So far, we're not really seeing any signs of a credit buildup apart from maybe what you're seeing in the consumer lending sector. In terms of market performance, as I said, the global markets performed well this quarter. You can see that all the major regions were up for the quarter. Much of that performance came in January and February. It was sort of a low single-digit return for March. S&P actually came in flat. But we saw for this month at least that the global ex-US did outperform the US, even though it underperformed in February. And so far this year, it looks like international markets, especially emerging markets, are outperforming the US. This global equity behavior has flown in the face of the Trump trade expectations. Wasn't the U.S. supposed to lead all other major markets? Weren't emerging markets supposedly hurt by protectionism, not be able to keep up with all the other markets? Europe in particular, facing its own populist revolts with upcoming elections, has also been performing well, defying expectations. Within the fixed income space, fixed income was roughly flat. The 10-year yield has been oscillating, although more recently it's been dropping. It did drop below 2.3% the other day. Long-term treasury yields ended the quarter on the low end. The 10-year yield, if you recall, had risen as high as 2.6% before dropping below 2.4%. So fixed income has been put in somewhat of a quiet quarter after a volatile fourth quarter. But precious metals are performing well. And again, this is another area that's defying the so-called Trump trade. Precious metals were supposed to come under pressure in the face of a cyclical recovery met with Fed tightening. However, commodities did come under pressure, but this was primarily driven by sell-off in oil prices as investors were concerned about a significant buildup in North American stockpiles. So really the theme for this quarter is the fact that the Trump trade is not exactly working out as people had expected. The first one was this expectation that small caps would outperform large caps and that value would outperform growth. Small caps were supposed to benefit from a U.S.-focused domestic agenda as well as a strong dollar. Value, consisting of financials, industrial cyclicals, also were expected to benefit from a domestic-led agenda of higher growth and a steeper yield curve. Growth sectors such as technology, consumer discretionary, and healthcare, in fact, led all other sectors this quarter, kind of define that cyclical recovery type of theme that was supposed to benefit under Trump. I would also note that first quarter was also not particularly kind for active managers. where the S&P's 6.1% return puts it in the 28th percentile among active large core mutual funds. This is based on using Morningstar screens. When large beats small and growth beats value by 5% apiece, it's not a surprise that active managers would struggle against these two major headwinds. For active management to generally work, you need breadth to widen and value dispersion to narrow, not the opposite. The dollar has also been weakening when expectations were that it would strengthen. Under Trump, an agenda combining higher domestic growth and fewer imports would potentially serve as fuel for a strong dollar. So far, it appears that policy advisors favoring a more conventional globalist approach are holding more sway with the Oval Office. Just point to an article recently published in the Wall Street Journal titled "5 Big Players Steer Trump's Foreign Policy Toward the Mainstream," where much of the foreign policy experts and advisors that Trump is now engaged with tend to be more globalist and less protectionist in nature. Another trade that's not exactly working out is the fact that the U.S. is lagging the rest of the world, at least so far this quarter, though that leadership could certainly change. Emerging markets have outperformed all other regions, and in addition, Europe, faced with its own populist results, was supposed to have underperformed as a region, but actually outperformed the U.S. this quarter. Strong broad market performance from Asia and Central America helped bring up emerging markets, although Eastern Europe was relatively weak, particularly Russia, which was down over 4%. Considering this bizarro world where expectations got flipped on their head, investors flock to certainty by opting for success and high quality. Generally, if investors are unsure what will succeed tomorrow, they generally buy what has been successful more recently, as can be shown with the strong performance of momentum as a factor followed by quality. The first quarter was driven by a narrow group of large growth stocks and sectors. Trump was supposed to usher in a new era of small cap and value outperformance, an environment supportive of traditional active management, but so far has only produced more uncertainty and a narrow-driven market as investors pay up for what they perceive as scarce growth opportunities. The Trump trade has been sidelined for now, but could reemerge if Trump's legislative agenda regains its footing. The 2 to 10-year yield curve is flattening in reaction to perceived administration failures and weakening macro conditions. Wasn't the 10-year yield supposed to spike to 3% on the heels of a hotter economy brought on by fiscal stimulus? Recall from what we observed at the beginning of the year in our last market commentary. Hedging interest rate risk may be tempting in a reflationary environment, but much of the losses have already been incurred in the fourth quarter. And shorting treasuries feels like a crowded trade, at least back when we mentioned it, where treasury net speculative position in treasury futures was was at an all-time high. So we highlighted how overcrowded this trade had become with the net short treasury short position future contracts at a cyclical high. That since has backed off as the treasury yield has come back down. We are definitely getting mixed signals on the near-term outlook. The Fed Atlanta GDP Now model, which takes into account economic releases as they come in and the GDP forecasts adjust to those releases, is now showing a 0.6% quarter one growth versus 1.7% forecasted by Blue Chip Consensus. The more recently, weakness has been driven by weaker auto sales, trade, housing, and services. Also concerning is a notable slowdown in bank lending and the buildup of consumer credit, especially housing and auto loans. But this weakness continues to be offset by robust employment conditions and tight labor markets that has led to an increased willingness on the part of businesses to boost capital spending, as highlighted in this graph, where the Philadelphia Federal Reserve studies show not only improving business conditions in terms of their outlook, but also in terms of their plans to spend on capital spending. Home building and home buyer sentiment remain strong, as do lumber futures, which have recently broken out to a cyclical high. So again, we're getting mixed signals on the economic front. However, I would mention that credit investors, which tend to sniff out problems earlier than other investors, are not so much concerned. We did see a bit of widening in credit spreads, particularly in high yield, but this was more in reaction to the sell-off in oil prices, which had fallen below $50 before recovering. So far, credit risk remains benign. This leads us to where we are with valuations. S&P Forward multiple trades north of 18 times, international at 15.6 times, and emerging markets at 12.7 times. But keep in mind that the lower valuations are offset by the fact that international markets are not as profitable as the U.S. So we kind of seem to be in this, what I would call long-term low nominal return range for equities implied by valuations, unless we see sort of a real remarkable recovery in earnings growth. As to the U.S., according to FactSet Earnings Insight, for the first quarter 2017, the estimated earnings growth rate for the S&P is 8.9%. If 8.9% is the actual growth rate for the quarter, it will mark the highest year-over-year earnings growth for the index since the fourth quarter of 2013. Yet this estimate started the year at 12.5% and has seen downward revisions across most sectors, primarily in the industrial segment. The key for 2017 earnings growth hinges on energy, which saw declines last year and is expected to recover earnings this year, as well as the financial sector. For all of 2017, analysts are projecting earnings growth of 9.8% on top of revenue growth of 5.3%. Key issues heading into 2017, DC is going to dominate the headlines. There's already concerns about a possible government shutdown at the end of this month when the emergency spending bills run out. So a new emergency spending bill will have to be passed. And then, of course, there are the longer term issues surrounding healthcare, tax policy, and so forth. And so the concern here is that the high expectations that we came in at the beginning of the year not only have been lower, but now there are concerns that much of what is expected with this administration might not actually pass through. There's also discussion about what the level of pace of Fed tightening is. With the recent rally in the bond market, Fed futures pricing is actually lowering their probability of rate hikes. And so it'll be interesting to see if this trend continues. This is probably brought on by the increased geopolitical tensions. A lot of this started with the bombing of the Syrian airport following the chemical attacks that were purported to have been made on a village in Syria, and also concerns about North Korea, whether they're going to launch a sixth nuclear test or not, and what the U.S. or China response might be to that. And of course, we're seeing continued pressure on the Eurozone. Although election results out of the Netherlands and Germany are pointing towards more mainstream candidates prevailing, there's still the French election that's coming up. And even beyond that, there's the Italian election later this year. So populist issues have not gone away in Europe. They may have been subsided since the passage of Brexit, but those do remain, as do deflationary pressures in Europe. So as I mentioned, if there are any questions, feel free to go ahead and ask them. One thing I would just highlight, and this is something that we're going to get in a lot more detail in our portfolio review, is that we did make a model change in our portfolios around late February, early March, where we went a bit more defensive in our fixed income portfolios in terms of duration and credit. Not much, but a little. And we also brought up our cyclical risk a bit in equities, but there weren't a lot of changes made to the model, and we're basically sticking mainly to the course that we've set out for the longer term. So it looks like there aren't any questions. Thank you again for joining us, and feel free to follow up with us if there are any additional questions or any other aspects of the market that you'd like to discuss. Thank you.